We start off with today's big reversal in JPMorgan shares plunging into the red midday after the company's consumer banking chief told investors that 2026 expenses will rise to $105 billion. That's more than 10% higher than this year, more than what analysts were forecasting. Those comments at the Goldman Sachs Financial Services Conference pulling down other bank names like Bank of America, Wells Fargo, and Citi. Leslie Picker is here on set with more on this. It was a big decline for those comments.
Yeah, it was pretty surprising. The way Lake described it is that the firm needs to spend more to grow more. And while the expenses are more than $4 billion higher than the street was expecting, she said that's largely due to higher activity levels, which drives more incentive compensation and marketing. The firm also plans to invest more in branches, bankers, and advisors, in addition to, yes, of course, AI. As analyst Mike Mayo pointed out in a report, the firm increased expenses more than expected also in 2022, which ultimately paid off. Mayo did note that this is the, quote, most competitive environment we've seen since the financial crisis for the industry. He implied that if the biggest of the big banks is increasing its spend, then the rest of the industry, including the regionals, may need to follow suit. And so that's why you saw a reaction in the stocks of B of A, Wells Fargo, and Citi in sympathy with the JPMorgan move today. Overall, though, the commentary across the industry was pretty positive. Wells Fargo CEO Charlie Scharf saying that consumer spending remains strong. Other executives saying consumers remain choiceful in what they spend on, but the cohort of people in distress isn't elevated relative to normal times. And we'll hear more from several industry titans tomorrow, including Ares CEO Michael Arrighetti, Blackstone President John Gray, and B of A CEO Brian Moynihan from day two of that Goldman Sachs Financial Services Conference here in New York City, Mel.
How should we think about that increase that is above what analysts had been expecting and higher than what it was this year? It sounded like a lot of the growth was going to be in compensation.
Yes.
And so how do we think about that as that sort of cost that will continue to rise versus actual strategic investments like investments in AI?
Well, just to put that number into perspective here. So it's about a $9 billion increase from what's expected this year. Total among the other big six, excluding Wells Fargo, because Mike Mayo is the one who did this work, and he works at Wells Fargo. But let's just put Wells Fargo aside. Their expenses are about $8 billion. Expected increase. So this one big Goliath, as he calls it, is more than the entire increase of the rest of, four of his big competitors. And so that's a pretty big number. Anything over $100 billion you look at for an expense figure, and that's pretty sizable. But to your point, the way that Lake described it is the biggest bucket is going to be kind of these drivers for growth, spending more on compensation to attract bankers, to attract advisors, basically leaning into this very conducive environment. The second bucket, which she described as being much smaller, is going to be kind of the investments that we think about, refurbishing the branches, investing in technology, investing in AI. And then that last bucket is going to be an increase due to inflation and real estate costs. So that's something I would say is kind of out of their control. Perhaps it's more of the macro environment that we're talking about. Everything else is a strategic investment as well as something that they're benefiting from the growth in their business. Yeah,